Good evening, everybody, and welcome along to this presentation by ATFX, brought to you in association with Trade with Precision. My name's Chloe, I'm from Trade with Precision, and we are going to be talking this evening about cutting out the common but critical trading mistakes. Thank you very much for your feedback. Audio and video are okay. Thank you, Vincenzo. Lovely to have all of you along. I'd love to hear from you if you want to introduce yourselves and let me know how long you've been trading, if you're new or more experienced, just so I get a feel for the room and where to aim the session towards. So before we get started, I am going to give you an opportunity to have a quick glance through the disclaimers and risk warnings. So here's the first one here. Just have a scan through that, make sure you agree with everything therein, and then we can get going with the presentation. Fantastic. Thanks for saying hello, guys. Lovely to see so many new faces and a couple of faces I recognize as well. So welcome along, everyone. I'll just give you another couple of moments to have a look at this next risk warning slide by Trade with Precision, and then we can get started once you've read through and agreed with everything therein. Okay, so we've got some fairly new traders, some slightly more experienced traders, mainly new, I would say, by the looks of things. Okay, let's get going. As I said, my name is Chloe, and I'm going to spend the next hour or so talking to you about the most common critical trading mistakes and how to overcome them. So, on the agenda for today, we are going to, first of all, find out why the majority of traders fail. I'm sure we have all heard the statistics about how many retail traders fail to make any money from trading, and in fact lose money from trading. So we'll find out why that is. Learn what are the most important errors to avoid in trading. Obviously, if we can learn what the important errors are, then we can start to avoid them, and then we can start to see a change, a positive change in our trading success. So we'll find out what the errors are and how to avoid them. And then we'll have a look at how the professionals learn by their mistakes and overcome them. So I usually like to keep these sessions as interactive as possible. This is more of a theory session than a technical session, so I won't go to the charts, but I'm just going to basically open the discussion up to you guys. Any kind of input that you want to have, any questions you want to ask, feel free. And what I'd like to know, first of all, those of you who are new to trading and also those of you who are more experienced at trading, what are the struggles that you find most commonly in terms of your trading success? Can you put your finger on what kinds of things that you struggle with and what kinds of errors that you make? So you can pop your answers, any comments you've got, into the questions box, and I will have a look through them. Okay, lots of different ones here, and they are all pretty common indeed. Okay, so we will start at the top, and really I think one of the most common and most critical trading mistakes is to trade without a strategy, or to trade using too many different strategies and chopping and changing between them, equally as damaging. So trading without a strategy, what that means is if you trade without a strategy, number one, you stand much more of a chance to allow yourself to be emotionally involved in the trade and allow your emotions to have an effect on what you do with that trade, whether you, where you enter or whether you enter, how you manage the trade, etc. If you don't have a strategy, your emotions will take over, and that is not a good thing. We want to avoid, where possible, trading with our emotions, and we'll go into a little bit more about emotions later on. So that is, I suppose, the number one reason we should have a strategy, is to avoid emotions in our trading. The other reasons that we should have a strategy, avoiding emotions, we also want to have a way of analysing our results. So if we have a strategy with fixed rules, then we know that really our trading results are a case of probability. And over a period of time, if we trade the exact same strategy, if we know that the strategy has a certain percentage win rate and a certain reward to risk ratio, then we can have the confidence that over a period of time we will make money if we trade that strategy correctly, despite individual trading results. So with a strategy, what we want with our strategy is we want it to be a step-by-step process. A trading strategy and a trading plan come hand in hand, really, and I like to definitely talk about having both. A trading strategy is something that tells you how to get into and how to get out of the markets, and there are lots of strategies out there that are working strategies, and what you need to do is write down in your trading plan. You need to have a clear strategy written down step by step and a clear trading plan. So that strategy must have the rules for entry of your trade, the rules for exit of your trade, whether that is a target or where your stop loss is, and you may even have more than one target. And those rules must be written down clearly, and you may have a strategy that involves indicators, in which case state exactly what criteria the indicators must meet in order to fill your strategy criteria. You may have a particular type of strategy that works in particular markets. Is it a trending strategy? Is it a ranging strategy? Is it a reversal strategy? Is it a reversion to the mean? There's all kinds of different strategies. We at Trade with Precision are trend-based traders. I am definitely a trend-based trader. I only trade with the trend. I have a couple of different strategies that I use, but they are all trending strategies. So I know that in my trading plan, I know that I am going to be trading trending strategies, and within that, I know exactly the rules of my strategies. Your trading plan can be as specific and going into as fine detail as which particular markets you're going to be trading. Are you going to be trading Forex markets? I can see there are a couple of people in the room who are already trading Forex markets. Are you going to be trading Forex markets? Are you going to be trading stocks? Are you going to be trading commodities, indices, metals? What markets you're going to be trading? Make sure that you have that clear, because it's no good chopping and changing between them as you feel like, because you're not going to get a good way of then analyzing those results and really working out what works for you. And some strategies may work better in certain markets than other markets, and some, of course, certain markets may be trending when others are not trending. So it is very important to be very specific about what markets you are and are not going to trade. So then you can go down to which time frames you are going to be trading. So are you going to be trading on the daily time frame, and are you going to be swing trading or position trading, or are you going to be trading on the intraday time frames, hourly time frame perhaps, or even lower? Whichever time frames you're going to be trading, make sure that that is written down in your trading plan. And then how much risk are you going to place on your trades? That is also very important. We're going to discuss risk a little bit further later on, because it is massively important, and one of the biggest trading mistakes that people do make is putting too much risk into their trades. So how much risk are you going to place into each trade? I personally place usually a maximum of 1% of my total count risk on each trade. 1% risk on each trade. There are times when I will scale into trades, but I will make the trade safe first. So 1% risk maximum on each trade is my personal rule. Which time of day are you going to be trading? Are you going to be getting up early in the morning to trade? Are you going to be trading late at night? Obviously, depending on which markets you're trading, this may have an influence on what time of day you're able to trade those. So that needs to be taken into consideration. And then, of course, back to the rules. Your exact entry, your exact target or targets, and your exact stop loss. Where are you going to be taken out of the trade if the market goes against you? And all of that goes into your strategy and your trading plan. Now, if you have a strategy and a trading plan, then that means that you can analyze your results in terms of how well you performed against what was written in your trading strategy and trading plan, not how well you performed in terms of how much money you made or didn't make. Ricky, there is no slide deck for this, it's just more of a conversation. So not on the first slide. The first couple of slides were the risk warnings that hopefully you read through. Now we're just having a conversation about the various trading errors that are most commonly made. So lost my train of thought there. So once you have the strategy and the trading plan written down, then you can monitor your progress against that rather than against your financial performance, because it's very difficult, and this is one of the other very common trading mistakes that people make, is to focus on the financial rewards rather than the consistency of execution of our trading strategy or trading plan. The markets will do what the markets are going to do. We can't control that at all. So we could enter a trade and it could win or it could lose. The markets don't really care what our strategy was and whether we want price to go up or down. So that trade could win or lose no matter how well we execute our strategy. But we must monitor our progress against how well we performed with our discipline and our strategy, not how well we performed in terms of how much money did we make on each individual trade. So it's about consistency and really learning to execute really, really well. Yes, getting lots of comments. The screen, I have no slide deck for this. I'm just taking you through some of the common trading errors and how to cut them out. So there is no, I'm not flicking through any slides. It is just a stagnant screen. Perhaps I mean, I could put it onto a screen with charts, but I'm not actually going to be talking about the charts, so wouldn't be much point doing that. So number one trading mistake, lack of strategy or not following a strategy. That is very, very important to have in place. Number two trading mistake, lack of risk management. Now, this is also very, very important. Lack of risk management means that, again, we will allow our emotions to get the better of us. If we place too much risk into a trade, then we're going to be trading emotionally. We must know what risk we place into the market before we enter a trade, and we must have a clear idea of that, a clear position for our stop loss. We must know what we stand to lose before we even enter the trade, and that must be a defined percentage of our account. As I said earlier, mine is 1%. If we another error alongside this is having unrealistic expectations of what the markets can give us. If anyone is looking for a get-rich-quick scheme, then trading is not for you, I can promise you that. So if we have unrealistic expectations, that will also lead to us placing too much risk in the market. We get greedy, and therefore if we take a losing trade, that is going to be very, very emotionally draining indeed. So having unrealistic expectations, definitely a common error that many people have. Blaming the markets. As I said earlier, the markets will do what the markets will do. They don't care about you or anyone, and so there is no point us blaming the markets for our trading performance. What we can do is congratulate ourselves on good performance if we follow our strategy and our trading plan to the letter. We must not blame the markets if we win or lose individual trades. Now, along with all of this, it all kind of ties in quite nicely with having the strategy and the trading plan. Another mistake that people make is they don't keep trading records, and they don't have a review process of how they are performing. Now, if you have a job, for example, I don't know, for I guess a supermarket or something, when you go to work, there's going to be records. You're going to keep records of what time you're working, what you're working on, etc. And you'll have a review process with your boss or whatever. It's pretty much the same with any job. Now, as traders, we don't necessarily have a boss. In fact, most of us retail traders don't have a boss. And therefore, we have to manage our progress and keep records and review our own progress ourselves. And that is, A, it's very, very boring and tedious, and B, it's quite hard to have the discipline to do that because it is so boring and tedious. But if we don't keep records and review, then we can never improve. If we're going wrong, we don't know what we're doing wrong, and we won't be able to fix that. So it's very, very important to keep a trading journal and keep records of every trade that we take. So we need to document what we did, why we did it. So what trade did we take, what currency pair or what instrument were we trading, or what time frame, what strategy we were using, why we took the trade in the first place, what the outcome of that trade was eventually, whether we made money, how much, what percentage return, if we lost money, how much. And then month by month, we can go back and review that. And that is what is going to tell us how to make progress. So we review what happened over the course of the month. I never recommend reviewing on a trade by trade basis. I always do my record, my trade journaling after every trade, but it's only at the end of the month that I will actually go back and review all of my trades for the month and look at them as a collective. It's about having a large sample set and building up consistency. And over that large sample set, you really can see whether what you're doing is working or not. And you can then work out which things are working, which things are not working, and what you can do to improve, if there's anything that you can do to improve. So we need to know what happened, what went wrong, and what we could do to improve. And we can only do that if we keep proper records and have a proper review process. So that is very important. Another very critical trading error is having a lack of discipline. Again, this all ties back nicely into having a trading strategy and sticking with it. We must have discipline. We can't enter a trade and then change our mind and decide to move the target or move the stop loss without having a specific strategy or plan for that. Of course, we can change our mind during a trade, but only if certain rules according to our strategy are met. It's no good moving our target because we're making loads of money on that one and we get greedy and we want to be more ambitious, because then price could turn around and come back against us and we could end up losing money or back down at break even or something like that. Absolutely definite no as well, moving stop losses away from price. So we need discipline to stick with our stop loss. The stop loss is there for a reason. It is there to prevent us losing more money than we want to or we're comfortable with. And it's also there as a reason not to be in the trade. So you place your stop loss at a place where you would no longer be in a position where you would want to be in that trade anyway. So why then would you move your stop loss? So we must have discipline to stick to our rules of trading. We must have discipline as well to stick to not only our rules when we're trading, but make sure that we're disciplined enough to trade regularly. Because another critical mistake is the failure to treat trading seriously as a business. Now, trading is a business. Well, at least for me, it is. It is my income, and therefore it is my business. And because a lot of retail traders just trade from home or they trade in their spare time as a hobby or whatever, a critical mistake is that they don't treat it seriously like a business. And any business has its business expenses and it has its due processes. And if we treat trading like a business where we have a set plan and we determine when we're going to trade. So I, for example, will have a couple of hours per day set out for my trading, where I will be actively at my desk trading. I will also have set times where I will do my market analysis at the beginning of the week. And I will also have set times where I do my reviews, my trading reviews, my performance reviews at the end of every month. So I treat it like a business. I stick to a timetable. That helps me with my discipline and it helps me build consistency. Another common mistake is a loss of focus or motivation. A lot of people start trading because it's all very exciting, or in fact, guys, you tell me, why was it that you started trading? What got you into trading in the first place? Let me know in the questions box. Why are you all trading or learning to trade or attempting to trade? Why is that? Yeah, everyone says to make money. It is true. The only reason we trade is to make money. Exactly. I mean, that is the reason that I trade. But money for what? Money for what is the real question. Some of you coming up here with yes, freedom to be financially independent. Why though? Why? Is it because yeah, more make money, to have a better life? Yes. To quit your job? Yeah, good one. To have a better life, how? Do you want to go on more holidays? Do you want to be able to treat your family? Do you have a family and children that you want to, you know, send through education? Do you want to help your parents in their retirement? Do you want to travel the world? Do you want to do charity work? Do you want to build a new business? Yeah, good one. Spend more time with family. These are the kinds of reasons. Yes, trading is to make money. There is no point me denying that at all. Trading is to make money, and that's why I trade. But in the back of my mind, always, I have the real reasons, the deep down reasons why I trade, the things that I care about in life, that I want to contribute to. And those are the things that motivate us. And when we first started trading, I don't think I'm any different from any of you guys. When I first started trading, it was a really, really exciting time for me. And I had so many goals and ambitions, and I was really impatient. I was like, oh my goodness me, I'm going to do this and I'm going to do that, and I'm going to set up this charity and that business. And you start trading and you realize actually it's not that easy. It is, trading is simple, but it's not easy. And it takes a lot of work and dedication and practice and discipline. And when you don't see immediate results, you know, maybe when you first start, you lose a bit of money. Maybe you might plod along at break even. The number of people I know who've been trading for a year and are plodding along at break even, or even longer than that, 2 years, 3 years, just around break even, maybe a bit under. It can be so demotivating and so demoralizing that a lot of people even just quit at that point. Once they get to the end of their tether, then they're not seeing the results, they quit. And giving up is the worst thing you can do, because then that's final. That is a finite end to what you're doing. If you give up, then that's it. You can't make progress from there. If you remember the reasons why you started trading in the first place, what motivates you, and focus on that, and work out a way to get that motivation to transfer itself over to your actions. I remember a very long time ago, probably 10 years ago, when I first started trading, I had a really, really silly motivation. I'm very much a visual person, and I gave myself rewards and punishments for sticking to my trading plan or breaking my trading plan. So I would get a reward if I stuck to the rules of my trading plan, and I would have to do a punishment every time I broke my rules. And that for me was a pretty good short-term motivation. I won't tell you what my reward and punishment was. They're all very individual. I know someone whose punishment was to send his ex-wife flowers every time he broke his trading rules, which was very painful indeed for him. I know people who have eaten very disgusting things that they would never want to eat as a punishment for breaking trading rules. And then if you, as a reward, you might want to take your partner out for dinner or something, so that your partner can see the rewards of all of this hard work you're putting in as well. So rewards and punishments help to build discipline. And absolutely, yes, trading is hard. We must keep our motivation up, keep our focus up, remember why we started in the first place. Just looking through. Thanks for your comments, guys. Really, really helpful. So let's have a look at one of the difficult psychological things that we struggle with as traders, is that we want a result. And that's why we start. So when we started trading, we wanted to make money. So we want that result. And when we start trading, we come closer to getting that result. But if we come too close, we get burnt. So that pain can then cause us to be fearful. So we start trading, but then we take a trade and we lose, and that is painful. And that pain can then cause us to be fearful or cautious of trading. And that can be a very, very unhealthy cycle. We want profit, so we place a trade, but if we lose that trade, we get burnt. And the emotional pain that we experience then causes us to be fearful of the markets, which means that we're afraid of then placing the next trade. So actually, how do we get over that dilemma? On the one hand, we want to trade to win, so therefore we place a trade, but there's no guarantee of success. And if we lose a trade, that is painful. And so to find a solution to this, we have to really focus on our trader mindset. And one of the ways that we can overcome a lot of these common and critical errors is by having the correct trader mindset. So we need to find ways that allow us to enter the market without fear and trade the market on our terms and conditions. As I've said before, the market doesn't care about us, about what strategy we're using or how much money is in our account. The market just doesn't care. And so we can't control the market. You know, I wish we could. I'm sure a lot of people wish that we could, but we simply can't. We can't control the market. So what we have to do is find a way that we can trade under our terms and conditions while accepting that we can't control the market. So we have to accept that we will have losing trades and we cannot avoid losing trades. We have to accept that, but how can we avoid the pain that goes along with those losing trades? We have to put in place methods to protect our emotional capital in the same way that we're protecting our trading capital. So we've talked about risk in terms of capital, financial risk, but we haven't really yet talked about emotional capital. And that emotional capital, once your emotional capital runs out, trading capital, financial capital, you can just replace, you know, with your next paycheck or your next winning trade or whatever. Emotional capital, once your emotional capital runs out, that is when people quit. So we have to find a way of keeping our emotional capital up. So trading can appear easy, and certainly before we even start trading, we can think that it might be easy. But once we start, that's when we realize how difficult it actually is, or a lot of people do find it difficult. But it doesn't mean that it's not achievable. So what we tend to find is we go through a cycle of thinking trading is going to be easy, finding out it's not easy, and then we have to work through that and find a way of keeping our mindset such that we continue and we fix all of these problems that I've discussed, the strategy, the plan, the keeping trading records, the discipline, the emotional control, all of these problems, we fix them gradually one by one to the point where eventually we come out at the end realizing actually this is achievable, and then we wonder what the fuss was and the struggle was in the first place. So we must find a way to manage our emotions, and the emotions can be good or bad emotions. So good emotions might be good emotions might be happiness or pride or gratitude, confidence, inspiration, all kinds of good emotions. And then we can also have negative emotions, so fear, doubt, anger, revenge, regret, greed, all of those negative emotions. We have to recognize these emotions and deal with them. And that's another thing that we should put down in our trading records. Each time we take a trade, what are we feeling emotionally? What are we feeling emotionally when we enter the trade? And what are we feeling emotionally during and after that trade? We must write that down because that's very, very important as well to keep a record of that. Keeping trading records, I know it might sound, you might be thinking, oh, I'm sounding very fussy about all of my trading records, but honestly, it is so important, because can you imagine, you might think, oh, I'll just remember that trade, or I'll look back on my account and find out how much money I made and lost, and that'll do. But actually, it won't do, because if I asked you what you had for lunch today, you'd probably remember and be able to tell me. But if I asked you what you had for lunch on the 6th of May, you probably wouldn't be able to tell me. Whereas if you wrote that down every single day, what you had for lunch, then you'd be able to look back and tell me, oh yeah, I had a chicken sandwich for lunch on the 6th of May. And it's the same with our trading. We might think as we're doing it that we're going to be able to remember the useful information, but we just won't. And we must keep trading records. Question here from Jonathan: what format do you keep your records in? Yes, I do actually. I keep an Excel spreadsheet. It doesn't really matter what format you keep them in. It's a personal preference. I know people who do them in Excel format. I know people who simply keep an actual physical notebook journal of their trades. You can do it in PowerPoint, in Word, however it is that you feel best. I like to have mine in Excel, so that's how I do mine. Let me just check that I'm not missing anything. Okay, I've got one question here that I don't think I have. A couple of questions I think I've missed. So let me make sure I go back over these. Don't want to miss anything. Question about a broker. We will come to that at the end, if you don't mind, about the brokers. How did I learn to trade when I started, and what resources and sources did I use? How did I learn to trade? Combination of things, really. I was lucky enough to have a trading mentor when I first started learning to trade, and he is still 10 years down the line my trading mentor to this day. So that is, I definitely attribute my success in finding a trading mentor. If you want to learn to do something, then the best way to do it is by learning from someone who is doing it themselves. So if you want to learn to trade, find a professional trader and learn from them. That is why these webinars are so useful, I guess, because I am a trader and I can chat to you as much as I get time for in the hour about trading and things that I hope will help you. Other resources, I've read a lot of books. I would say I don't learn so well from books. I prefer to have, I'm a very visual learner, so I prefer to have visual ways of learning rather than from books. A lot of back testing of strategies, because someone can give you a strategy, but unless you have the belief yourself that that strategy will work, then it's very hard to actually make it work, because you will end up changing the rules, or thinking you're doing it not quite right when you actually are, or vice versa. If you actually go through the process of backtesting, go back through historical charts with your strategy and mark out where you would have taken a trade, what the result would have been over a period of time. I mean, I've spent probably thousands of hours doing this, and that means that when you actually come to trading that strategy, you have the absolute confidence that that strategy works. You know the exact percentage success rate that it has, the exact average reward to risk that it has, and you can then trade that with confidence and stick to the rules of that. So definitely that is something that I did as well. How many years of experience do I have? I have been trading since 2010, so 9 years of experience. What notes do I take regarding my journal? My journal, absolutely everything. Honestly, absolutely everything. So it will be what I'm trading, what instrument, whether it's a currency pair, or whether it might be gold, or it might be stock, or whatever it is. At the time frame I'm trading, the risk that I place on the trade in percentage of my account, usually 1%. The time of day that trade is, obviously the time I get into the trade, the time I got out of the trade, what percentage return I saw on that trade, whether that was a loss or a positive return, what strategy I was using for that trade, and what I was feeling throughout. So when I entered, during the trade, and when I exited the trade. So I pretty much record everything that I can. I also take a screenshot. I take a screenshot of the trade at the end, and I mark out where my entry was and where my exit is. And I put that screenshot in there as well, because as I said, I'm a very visual person, so that's the thing that I find most useful for me. So going back to emotions then, if we have positive emotions, that is not necessarily always a positive thing, because if we feel a lot of happiness from a winning trade, that could actually be a sign of a lack of discipline and a lack of consistency. So we should learn to feel happy about good trading, not good results. So we should feel happy about executing our plan perfectly, rather than winning or losing money. Because it is possible, as we've said, that a good trade placed correctly according to our strategy could still lose money. So we want to avoid feeling unhappy when that happens, and avoid feeling happy when we make money. Things like hope definitely shouldn't be a part of a trader's vocabulary, because that could indicate a lack of trust in your strategy. Another question from Priscilla: how many trades do I do simultaneously at a given time on average? I honestly couldn't give you an average, because it varies so much. I do a lot of traveling, and when I'm traveling, I tend to only trade on the daily time frame. So I would probably only be in 2 or 3 trades at any one time. When I'm at home and I am trading for a couple of hours a day, I could be in anything up to maybe 10 trades at any one time, but they won't all be 10 trades at risk. Some of them may be trades where I've trailed my stop or already taken some profit on, so that is not a full 1% of my account at risk on 10. So I would never have 10% of my account at risk on any one time, but I might have 3 trades that are in profit and my stop losses at least break even or better, which then means I can enter another 3 or 4 trades or something like that, if that makes sense. So I can't say an average, it really depends on what I'm doing, but really anything between 0 and 10 probably. Pride often comes before a fall, so a lot of people are very boastful of their trading results when things are going well, and that more often than not leads to things not going so well, because it makes us greedy. When we've got something to show off about how much money we're making, oh look at how much money I'm making, makes us greedy, it makes us change our risk. Definitely not a good thing. So over to you guys. Can you list any occasions where a seemingly positive emotion can actually be a problem for your trading? So for example, happiness or confidence. Can you see how those positive emotions can actually be negative for your trading? What do you guys think? Yes, absolutely. Greed ruins everything. I could not agree with you more. Yes, absolutely. Overconfidence, very destructive indeed. Confidence is a positive emotion, but overconfidence in trading can be very, very destructive. It can lead to entering more trades than we should, or it can lead to us going with gut feel rather than a strategy, which is never a good thing. It can lead to us to increasing our risk on a trade. If we're super confident that trade's going to win, we might up our risk, and we've got no way of actually guaranteeing that that's going to win. So yes, overconfidence, definitely destructive. And yes, absolutely, being more focused on the financial reward rather than the execution of the strategy. The feeling of having to prove to others that you're a successful trader, that is really really pertinent actually, and I've been through this myself because I changed careers. I used to have a completely different career. I haven't always been a trader, and I really felt like I had to prove myself because I did leave what was a perfectly good career that I was really, really good at to become a trader, and therefore I really had something to prove to my friends, to my family, etc. And that was a very, very difficult burden to bear emotionally that has taken a long time actually to get over. Negative impact of negative emotions: greed, fear, doubt, anger, revenge, over or underconfidence, regret. These kinds of things can lead to us staying in a trade too long, but especially greed, staying in a trade too long to catch a larger and highly unpredictable move. That is greed-driven trading. We want to avoid that. Placing too many trades and risking too much per trade, also signs of greed. We do not want to be doing those things. Fear, paralyzing effect of fear. This could lead us to hesitation, avoiding taking trades in the first place, poor decision making, very, very negative things there. Doubt that our strategy works. Revenge, if we lose a trade and we want to make that money back, we run the risk of taking a trade that we shouldn't. So the way that we can manage emotions, as I've said before, having a strategy and sticking to it, applying risk management, trading when we're feeling at our best. If we're not feeling good, whether that is physically, hangover, sickness, whatever, or emotionally, argument with a loved one, etc., stay away from trading at those times. Definitely conduct regular trade reviews of past trades. Look for sources of constant improvement and learn to think in probabilities. Don't think in single trades. Any single trade could be a winner or a loser, but it is the net result over a consistent period of time with a large sample set of trades that we know what our probability of success is. Just making sure I haven't missed anything. I think I've pretty much gone through everything that I wanted to say. Good question. What indicators do I use? As I said, I do have a couple of different strategies that I use. I am predominantly a trend-based trader. I use price action first and foremost. I also use moving averages. I use MACD and RSI as momentum indicators. I try and keep things as simple as possible, so I don't use loads and loads of indicators actually. I just try and keep things very, very simple. We must learn that losing trades are part and parcel of trading, and we must see them as a business expense. Every business has an expense, whether that is an electricity bill or paying rent for a premises or whatever it is. We're lucky as traders in that we don't have very many expenses actually, but losing trades are part and parcel of trading, so we must treat that as a business expense. If we don't have losing trades, then we don't put ourselves in line to have the winning trades. It's not easy because of course we've all got an ego. No one likes losing trades, but we must learn to embrace them as part and parcel of being a trader. If we are too risk averse, when we have a winning trade, if we want to close the trade early just to bank that little bit of profit, because we're risk averse, we don't want the profit to turn into a loss, that can actually be a negative thing, because it can mean that we have lots of small winners, but we still have large losers, because we're more likely to cut our winners short and yet let our losers run all the way to the stop loss. So we want to avoid that. If we have lots and lots of small winners, we can still end up losing overall if our losses are bigger. So it's actually much better to have a positive reward to risk ratio. Make sure our winners are bigger than our losers, and then even with a 50% success rate, we will still make money overall. That is a little bit about the competitive nature in all of us. I am definitely one of these people. For me, it's not about making or losing money. For me, it's about being right and being wrong. I hate being wrong and I love to be right. And so trading for me is a very, very difficult thing for that reason, because it took me a very long time, and in the beginning days I always felt like if I lost a trade, it was because I was wrong, and I hated that. And if I won a trade, it was because I was right, and I loved it. So it wasn't even any emotion about making or losing money. It was just about being right or being wrong, and I really had to work hard to overcome that. And learning to treat being right as executing my trading plan perfectly rather than being right as making money. I really had to focus on separating those two things. So as long as we are aware of some of these trading pitfalls, we can record them, acknowledge them, and study them, and that can start us off thinking differently and putting us into the correct mindset to start overcoming some of these critical mistakes that that traders make. Another thing we should always do is set goals. Realistic goals. Goals should be specific, measurable, achievable, relevant, and time-based. I'm sure you've all heard about SMART goals: specific, measurable, achievable, relevant, and time-based. So we want to set goals that are stretching us, but definitely achievable, because if they're not achievable, then we're going to lack motivation to to continue. We should be specific so that we can really head towards that, write it down in as much detail as possible, and that way we can feel motivated and really keep going towards that, reaching that goal. So I believe we have probably just about run out of time. So let me just finish off by giving you a little bit of information about ATFX. Why choose ATFX? They are regulated by the Financial Conduct Authority. Now, I did have a question earlier on about how to choose a broker. You do want to make sure that you're choosing a broker that is regulated, and it should either be regulated in the UK or in Australia or in some kind of country where the regulations are stringent. So ATFX being regulated by the FCA in the UK is definitely a fantastic thing. They've got an efficient, secure, easy-to-use payment portal. They are committed to providing competitive prices for the clients. Obviously, trading, we have another expense is the commission that we pay on trades or the spread. So obviously, having competitive prices is definitely a bonus. They have the most widely used trading platform, which is Mt4. So definitely check that out. In fact, I will give you a little bit of a look at that at the end in a moment. And of course, they have a bespoke customer service and trade support for all client trading needs 24/5. So let me just take you to that, to the platform, which is just here. So this is the Mt4 Trading Platform. Hopefully, I think most of you have got at least a little bit of experience trading, so none of this should be too new to you. This is the trading platform. It's really simple to use once you find your way around it. It is one of the most widely used platforms, and this is the ATFX, a platform of choice. So that is a fantastic thing as well. I did see a couple more questions. Let me just go back to that. Minimum amount of money for trading. Now, you can open a trading account with as little as probably £500, probably even less. It depends on what time frame you want to trade. If you have a very small account, you may struggle to risk size appropriately and position size appropriately if you're going to be trading a daily time frame, for example. So my personal view is that a good level to start off with is at least £500. I would probably start with £1,000, but it really depends. Yes, Aussie Swiss. Okay, so thank you very much everyone for listening this evening. I hope you found some little gems that have been helpful to you. Always happy to answer any questions, so thank you very much those of you that have popped questions in the questions box as well. I really do hope to speak to you again in the not too distant future at another one of these webinars. I know there are a few questions about strategy and what indicators I use and things like that. We do these webinars relatively regularly, and they do cover various different topics. So I did do a webinar about a month ago all about indicators. So do keep an eye out for what webinars are coming up, and I have no doubt that you will find something that will get your questions answered. And also, please do, if you do have anything that you want to, learn about, then please do feel free to get in touch with the customer services team, and if there's a topic that you want a webinar on, please do tell us, and we will be more than happy to put one together for you. So with that, I will wish you a very, very good evening. Thanks for being with us this evening, and I will hopefully speak to you very soon. Cheers, everyone.